Hey everyone, welcome back to Corporate Decoder. Today, Allspring Exchange-Traded Funds Trust just filed their N-CSRS certified shareholder report, and I am seeing some interesting trends in bond holdings. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a deep look into two of their ETFs, Income Plus ETF and SMID Core ETF, specifically for the 6 months ending the 31st of March 2026, and it reveals how they are navigating the current economic landscape. This is essentially a detailed report card for these investment funds. It tells shareholders exactly what they own and how the funds performed, focusing on the period from the 1st of October 2025 to the 31st of March 2026. It is a regulatory requirement, but for us, it is a goldmine of information about investment strategies and the health of these particular funds. Let's dive into the Allspring Income Plus ETF first. It is aiming to generate income, and this report shows us precisely how it is doing that. The first thing investors often look at are costs. For a $10,000 investment in the Income Plus ETF, the costs for this 6-month period were about $18, which works out to 0.35% of that investment. That is not too bad, especially considering it is an annualized figure, meaning the actual cost over the 6 months was likely lower. The report also clarifies that the manager pays most of the expenses, which is a good sign for investors because it means their money is being invested rather than spent on operational costs. Now for the core numbers, the total net assets for this fund were just under $196 million. That is a substantial amount of money. They held 429 different investments, which suggests a good level of diversification. However, the portfolio turnover rate was a whopping 99%. This is very high, and it means they were buying and selling their holdings at a rapid pace. A high turnover rate can lead to higher trading costs and potentially higher taxes for investors, even though the report doesn't explicitly detail those here. It hints at a very active trading strategy. Looking at what they invested in, the top holdings are heavily concentrated in what are called agency securities like GNMA and FNMA, and also US Treasury bonds. For example, GNMA securities maturing in 2056 made up 8.2% of the fund, and FNMA securities made up 6.8% and 6.6%. They also have exposure to foreign government bonds with Brazil, France, Spain, Italy, and Colombia all featuring in the top 10. This mix suggests a strategy focused on stable income from government-backed entities, but with a willingness to take on some international risk for potentially higher yields. This part talks about the creditworthiness of the bonds they hold. A large chunk, 35.7%, is rated AA, and another 13% is rated A. These are generally considered high-quality investments. However, about 20.6% is rated BBB, and a further 14.6% is rated BB. This means a significant portion of their fixed income investments are in what is called the investment grade category, but also a good chunk sits in the speculative or junk bond territory. This blend indicates they are seeking higher yields by taking on more credit risk. The allocation breakdown shows a significant portion, 24.4%, in agency securities. This ties back to the top holdings we saw earlier then. 22.7% is in corporate bonds and notes, and 17.6% in foreign government bonds. This confirms a diverse yet heavily fixed income, focused portfolio. Now, let's dig into the actual financial statements. This is where the nitty-gritty details live, and it is always worth a look to understand the real financial engine of the fund. Here we see the full list of holdings. For example, under agency securities, we see specific holdings like FHLMC bonds and FNMA bonds with their interest rates and maturity dates. It is very granular. Under corporate bonds and notes, we see specific companies like Celanese US Holdings, Chemours, and Alphabet. This level of detail is important for understanding the specific risks and opportunities within the fund's portfolio. They've invested over $58 million in agency securities alone. That is a huge chunk of the fund's assets, emphasizing the stability and income generation focus of this part of the portfolio. Then there are asset-backed securities, totaling over $11 million. These can be complex, often tied to things like mortgages or auto loans, and they can carry unique risks. Over $54 million in corporate bonds and notes shows they are actively participating in the corporate debt market, looking for yield from businesses. Foreign corporate bonds and notes add another layer of diversification and risk, with over $22 million allocated here, and a hefty $42 million in foreign government bonds. This shows a significant international fixed income bet seeking global diversification and potentially higher interest rates. Finally, about $14.8 million is in US Treasury securities. While the US Treasuries are generally considered very safe, The fund's allocation here is less than some other categories, suggesting they are balancing safety with the pursuit of higher returns elsewhere. This section is crucial. It shows they have over $1.3 million invested in affiliated securities, specifically the Allspring Government Money Market Fund. This is common for money market funds to hold their own provider's cash management product, but it is worth noting any potential conflicts of interest, though the report calls this an affiliated person of the fund. The fund is actively using forward foreign currency contracts. They have unrealized gains of over $600,000 and unrealized losses of under $170,000. This suggests they are using these to manage currency risk, and so far it seems to be working in their favor, though there is always risk involved. They are also using futures contracts, both long and short positions. The long positions are in US Treasury notes and bonds, while the short positions target Eurobond index, Euro bubble, and ultra US Treasury bonds. This complex dance with futures contracts indicates they are actively trying to play the interest rate market, potentially hedging against rising rates or seeking to profit from falling ones. They are using credit default swaps. They are buying protection on investment grade indexes, which is a defensive move, but also selling protection on high yield indexes, which is a more aggressive strategy aimed at generating income. This is a sophisticated financial tool that can be very risky if not managed properly. Here we see the overall financial health snapshot. Total assets are about $264 million, while total liabilities are around $68 million. That gives us total net assets of approximately $195 million, matching what we saw in the key statistics. The fund earned over $5.5 million in investment income, primarily from interest. However, they also had significant unrealized losses on investments, totaling over $4.8 million. This is a major factor impacting their net assets. The net realized and unrealized gains and losses section shows a significant net loss of over $3.7 million on investments. This is largely driven by those unrealized losses, meaning the value of some of their holdings decreased during the period, even if they haven't sold them yet. This table shows how the net assets changed. The operations resulted in a modest increase of about $1.5 million. However, distributions to shareholders were over $6 million, meaning more money was paid out than earned from operations, which reduced the overall net assets. The financial highlights give us a per share view. The net asset value per S-share at the end of the period was $24.79, down from $25.37 at the beginning. This drop is primarily due to those investment losses we saw earlier. The total return for the period was 0.75%, which is quite low, especially considering the high activity in the fund. The expenses for the fund remained stable at 0.35%, which is good, but the net investment income ratio was 5.25%, indicating that while they are earning income, the overall performance was dragged down by market movements. The portfolio turnover rate of 99% really stands out here. This section details how they value their assets. Most of their investments, a vast majority, fall into level 2 of the fair value hierarchy. This means they are valued using observable inputs like market prices for similar securities or interest rates. Only a small portion, like common stocks and investment companies, are in level 1, meaning they are valued using quoted prices in active markets. This is generally a good thing, as it means their valuations are not heavily reliant on subjective judgments. The notes to financial statements provide crucial context. The fund is managed by Allspring Funds Management. The management fee is 0.35% of average daily net assets. This fee is quite reasonable compared to many actively managed funds. They also mention they have a distribution plan but are not currently charging a fee. Let's shift gears and look at the SMID Core ETF. This fund focuses on small and mid-cap companies, and its strategy is quite different. For the SMID Core ETF, the costs for a $10,000 investment were about $20 or 0.38%, slightly higher than the Income Plus ETF, but still within a reasonable range. This fund has total net assets of about $54.5 million. It holds only 51 portfolio holdings, meaning it is much more concentrated than the Income Plus ETF. The portfolio turnover rate is 23%, which is significantly lower than the Income Plus ETF, suggesting a more buy and hold strategy. The sector breakdown is very revealing. Information technology takes up 17.9%, financials 18.2%, and industrials 19.2%. Healthcare is also a significant portion at 14.5%. This points to a growth-oriented strategy, investing in companies expected to grow their earnings and revenue, typical for small and mid-cap funds. The top 10 holdings are concentrated, as expected, with only 51 total. Companies like TK Corp, MCore Group, and DigitalOcean Holdings are in the mix. Many of these are not names you hear every day, which is common for SMID cap funds as they often invest in smaller, less known companies. Looking at the actual stock holdings, we see companies like EverQuote, AMC Networks, Brinker International, Pulter Group, and Abercrombie and Fitch. These are all in consumer, discretionary, or communication services sectors, aligning with the sector allocation. For instance, EverQuote, an insurance marketplace, and AMC Networks, a media company, are listed. The fact that many of these are marked as non-income earning securities, indicated by the little dagger symbol, means the fund is likely focused purely on capital appreciation from these stocks, not dividends. In the energy sector, they hold Chord Energy, Northern Oil and Gas, and TK Corp. TK Corp is a shipping company that transports oil and gas, which is interesting given the broader energy market trends. Their position in TK Corp made up 2.9% of the net assets, showing a significant bet on that single company. The financial sector is dominated by banks like Axos Financial, Bank Osk, and Customers Bancorp, along with capital markets firms like StoneX Group. This shows a clear focus on companies that benefit from economic activity and interest rate movements. The healthcare sector is diverse, with holdings in biotechnology like United Therapeutics Corp and healthcare providers. The fund's investment in United Therapeutics Corp was 2.8% of net assets, again showing significant concentration in individual names. Industrials are the largest sector allocation. This includes companies involved in construction, electrical equipment, and machinery. Powell Industries, for example, which provides electrical distribution and control technology, was a notable holding. In technology, they're invested across various subsectors from electronic equipment to software. Companies like DigitalOcean Holdings, a cloud computing company, and Pegasystems, a software company, are included. The fact that these tech stocks are often marked as non-income earning underscores the growth focus. For the SMID Core ETF, total assets are about $54.5 million, with total liabilities very low, around $16,000. This results in net assets of $54.4 million. The fund is doing well operationally with total distributable earnings of over $2.6 million. Investment income for this fund was about $197,000, primarily from dividends. Expenses were around $74,000, leading to net investment income of about $123,000. However, the real story here is the realized and unrealized gains, which were a substantial $2.1 million for the period. This is where the growth strategy really shows its potential. The statement of changes in net assets shows a solid increase of over $2.2 million from operations. They also had significant inflows from capital share transactions, which is normal for an ETF. The net asset value per share grew from $26.36 to $27.89, a healthy increase, and the total return for the period was a strong 6.02%. The expenses are at 0.38%, which is competitive, and the net investment income ratio is 0.63%. The portfolio turnover rate of 23% is relatively low, indicating a more stable, long-term investment approach compared to the Income Plus ETF. What I see here is a tale of two ETFs. The Income Plus ETF is playing a defensive yield focus game, heavily weighted towards fixed income. But with a high turnover that raises some questions about its efficiency. The SMID Core ETF, on the other hand, is in growth mode, betting on smaller and mid-sized companies, particularly in tech and industrials, with a more stable portfolio turnover. The higher concentration in the SMID Core ETF means individual stock performances will have a bigger impact. For the Income Plus ETF, the big question is whether the high portfolio turnover is adding value or just incurring costs. The significant unrealized losses also indicate potential vulnerabilities. In contrast, the SMID Core ETF's growth strategy appears to be paying off with strong gains. But the inherent risk of investing in smaller companies means more volatility is likely. The risk I am watching is the concentration in certain bond types and foreign governments for Income Plus ETF, and the overall market sentiment towards growth stocks for SMID Core ETF. My biggest concern is how these funds will perform in a more challenging economic environment, especially concerning rising interest rates for fixed income and a potential economic slowdown for growth stocks. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.